This is Meet Sean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
Imagine standing on the shoulder of a really busy highway. You're shaking, the airbags are deflating, your heart is just pounding in your ears, and you are staring at the completely crushed front end of your car.
It's an awful feeling.
It is. And in that exact moment, while you are purely focused on, survival, a financial timer silently starts ticking down. Because the reality is the words you say and the actions you take in those next, say, 10 minutes, they could end up costing you thousands of dollars.
Oh, absolutely.
So, welcome to today's deep dive. We are talking about the financial risks of the road and really how to protect your wallet when the absolute worst happens.
Yeah, it's such a critical conversation to have because there's a profound disconnect between how we view driving and how the insurance industry views it.
Right.
We see driving as a physical task, You press the brake, the car stops, it's physics. But the second metal hits metal.
The physics vanish.
Exactly. The physics vanish, and you are instantly dropped into this labyrinth of contracts, liability clauses, and these rapid-fire financial calculations.
And let's be honest, most of us have no idea how to navigate that labyrinth. We just buy auto insurance hoping it acts like some kind of magic shield.
Right. You buy it and forget it.
Yeah. And then when we actually need it, we realize we really don't understand what we've been paying for. So think of this as your survival guide. We're pulling our insights today from 3 incredibly detailed resources from SeanWillInsure.net.
Yeah, those guides are excellent.
They really are. They were put together by Sean, who is a financial representative working with Raymond James Financial and Allstate Insurance down in St. Petersburg, Florida.
And they're fantastic sources because they really bridge that gap between the abstract policy language and the harsh reality of an actual crash site.
Exactly. So today we're going to look at the immediate aftermath of an accident. We'll explore the absolute demographic wildcard that is adding a teenager to your policy.
Always a fun one.
Oh, yeah. And finally, we're going to master a really crucial financial safety net, which is GAP insurance.
Which is probably the most misunderstood coverage out there.
I totally agree. But I want to start right on the shoulder of that highway, because the sources are very adamant that before we can even begin to talk about coverage limits or GEP or premium costs, we have to look at the mechanics of the claim itself.
The literal scene of the accident.
Right, because the mistakes people make while their adrenaline is still spiking are just brutal.
Yeah.
I mean, step 1 is obvious, right? Check for injuries.
Yes. But even if you feel fine, you really have to get medical help fast. The sources highlight that injuries like whiplash or, internal trauma, they don't usually show up until hours or even days later.
Right, because adrenaline is like nature's painkiller.
It is, but it is also a massive liability in an accident because it masks physical injury, and honestly, worse than that, it compels you to talk.
Oh, man, yeah. The nervous rambling.
Exactly. It is just human nature to want to step out of the car and immediately apologize or to start piecing together the narrative with the other driver, saying things like, oh, I'm so sorry I didn't see you, or the sun was in my eyes.
But you have to fight that urge.
With everything you have.
So the golden rule here is 0 speculation. Never, ever discuss who is at fault at the scene.
Not with the other driver, and frankly, not even with the responding police officer in terms of subjective narrative.
Right, you just stick to the facts.
Exactly, just provide the concrete facts. I was traveling north, the light was green. Because you have to remember how insurance adjusters operate. An adjuster's job isn't to be a sympathetic ear.
They aren't your therapist.
Right. Their job is to determine liability based on a strict legal threshold. So any passing apology you make on the side of the road can, and absolutely will, be logged as an admission of fault.
It makes complete sense when you frame it legally like that. I mean, you're in shock, your hands are trembling. Trying to litigate the crash on the side of the highway is like trying to defuse a bomb while riding a roller coaster.
That is the perfect visual.
You are in no state to be your own attorney right then.
No, you're really not. So instead of talking, direct all that nervous energy into documentation. You basically need to become an accident scene investigator for 5 minutes.
So taking pictures.
Yeah, take photos of the vehicle damage from multiple angles. But go wider, too. Photograph the road conditions, the weather, traffic signs, any skid marks.
And obviously getting the other driver's info.
Yes, collect the contact information, license plates, and VINs. And this is a step people constantly miss: get the names and phone numbers of witnesses before they drive away.
Oh, that's huge. Because once the scene is cleared, it's just your word against theirs.
Exactly. And then keep all of those photos and the police report in a dedicated folder. But here is where the financial timer you mentioned earlier comes in.
Right.
You do not have unlimited time to process your emotions before you call your insurer. The reporting deadlines are notoriously strict.
What are we talking about here, like a month?
Oh, no. Our sources note that for most standard insurers, you have a window of about maybe 3 to 5 days to notify them of an accident.
Wow, okay. That's
And it gets tighter. For certain comprehensive coverage claims, say a tree falls on your car or there's severe weather damage, they might require notification within 24 hours.
Just 24 hours.
Yeah. And if you miss that window, you are effectively giving the insurer grounds to delay your claim, complicate their investigation, or honestly deny the payout altogether.
That is terrifying. Okay, so let's look at what actually happens when you make that call. You get the adjuster on the phone, and suddenly they're throwing out terms like liability, collision, and deductibles.
It's like learning a new language.
It really is. So I want to break this down. So you listening are armed with the actual mechanics.
Let's start with liability versus collision. They serve entirely different functions. Liability coverage is outward-facing. It pays for the damage you cause to other people.
Like their medical bills.
Right, their medical bills and the repairs to their car. It does not cover your vehicle. Collision coverage, on the other hand, is inward-facing. It pays for the damage to your car regardless of who caused the accident.
Okay, got it. And then the deductible is basically your financial skin in the game. It's the gatekeeper to actually getting your car fixed.
That's the mechanism behind it, yes. Insurance companies use deductibles to prevent just an avalanche of minor, frivolous claims.
How does that math actually play out?
Well, the sources provide a very clean mathematical example. Let's say you have a $500 deductible on your collision coverage. You get into a crash, and the body shop says the repair bill is $2,000.
Okay.
The insurance company does not just hand you $2,000.
Yeah.
You are contractually obligated to pay the first $500 out of your own pocket.
So you pay the auto shop the $500.
Exactly. And only after you have absorbed that initial loss does the insurance company step in to cover the remaining $1,500.
Okay, that makes sense. So we've established that one bad decision at an accident scene can trigger a massive headache. Even for an adult who has been driving safely for 20 years, a crash is a logistical and financial nightmare.
Totally.
But insurance companies don't just look at an individual crash, right? They look at demographic risk.
They do.
And there is no demographic risk more terrifying to an actuary than a 16-year-old with a freshly printed license.
Oh, without a doubt. The transition from a policy with 2 experienced adults to a policy that includes a teenager is arguably the biggest premium shock a family will ever experience.
Like a second mortgage.
It really feels like it, and it comes down to cold, hard statistics. The CDC data highlighted in our sources notes that motor vehicle crashes are the leading cause of death for 16 to 19-year-olds in the U.S.
Which is just awful. But it makes sense because they just lack the reps. They don't have the muscle memory for how a car handles in the rain or how quickly traffic can stop on a highway. And then you add a smartphone to the mix, and it's just a recipe for disaster.
The actuaries are just pricing in the mathematical certainty of inexperience. There is actually a quote from Mark Twain included in the sources that captures this developmental reality brilliantly.
Oh, I love this quote.
Yeah, Twain said, "When I was a boy of 14, my father was so ignorant I could hardly stand to have the old man around. But when I got to be 21, I was astonished at how much the old man had learned in 7 years."
It perfectly distills that absolute teenage overconfidence.
It really does.
But if you're the parent footing the auto insurance bill, that overconfidence is incredibly expensive. So let's dig into the strategies for surviving this. How do you lower those astronomical costs without putting your kid in like a cheaper, less safe vehicle?
Well, the industry actually offers several really powerful levers to pull. The first is the good student discount.
Which I always found so weird.
Really? Major insurers will frequently offer a discount, sometimes ranging from 5% all the way up to 25% if a teenage driver maintains a 3.0 GPA or higher.
I just want to stop right there because the psychology of that is fascinating to me. Why does an insurance company care about high school algebra? It's not like knowing the Pythagorean theorem helps you parallel park.
It's true.
But they must be using grades as a proxy for something deeper, right?
They use it as a proxy for executive function and impulse control. Yeah, the teenage brain is literally still developing its frontal lobe, which governs risk assessment. So insurers have mountains of data showing that a teenager who possesses the discipline to sit down, do their homework, and, delay gratification to earn a B average, they are statistically much less likely to impulsively run a yellow light or race their friends down a suburban street.
Okay, that actually makes perfect sense. So good grades prove you aren't entirely impulsive.
Mm-hmm.
But what about tracking their actual driving? The digital chaperones.
Oh, telematics. Yeah, telematics are revolutionizing auto insurance.
These are the safe driver programs, right?
Yes. State Farm's Drive Safe and Save, Allstate's DriveWise, or Progressive Snapshot. They use either a plug-in device in the car's diagnostic port or honestly just a mobile app leveraging the phone's accelerometers and GPS.
And they track everything.
Everything. They don't just track where the car goes. They track the G-forces involved. They record how hard the car is braking, how rapidly it accelerates, what time of night it is being driven, and even whether the driver is interacting with their phone screen while the car is in motion.
That is an unbelievable amount of actuarial data. It essentially gamifies safe driving for the teenager.
It does.
Because if they drive smoothly, the parents save money.
Right. And it forces a conversation about driving habits based on objective data rather than a parent just, lecturing.
You're driving too fast. No, I'm not.
Yeah.
Now you have the app to prove it.
Exactly. Now, the vehicle itself is the next major factor. The instinct for a lot of parents is to buy an older, heavy beater car for their teen to learn in.
Because it's cheap and they're probably going to scratch it anyway.
Right. But insurers actively reward modern safety technology.
Because safety tech prevents the collision in the first place.
Precisely. The sources strongly recommend safe, mid-sized sedans like a Toyota Camry, a Honda Civic, or a Subaru Impreza. But it's not just about the brand. It's about specific acronyms, ABS and ESC.
Anti-lock braking systems and electronic stability control.
You got it. ESC is particularly vital. It uses sensors to detect when a car is losing traction. So like if a teen takes a corner too fast on a wet road,
right?
The system automatically applies the brakes to individual wheels to prevent the car from spinning out. Features like that, combined with multiple airbags, drastically lower the chance of a severe accident, which lowers the insurer's potential payout, which in turn drops your rate.
Okay, so buying a safe car, using a tracking app, and demanding good grades helps mitigate the teen risk.
Right.
But are there levers anyone can pull, regardless of whether they have a kid on the policy?
Oh, definitely. The most immediate one is bundling.
Oh, like combining home and auto.
Exactly. The sources point out that keeping your auto policy and your homeowner's or renter's policy with the exact same provider is highly incentivized.
How much does it actually save, though?
Well, say you have an $800 auto policy and a separate $1,200 home policy. You're paying $2,000 total. By bundling them under one roof, the insurer might apply a multi-line discount that drops that total to, say, $1,700.
That's significant.
It is. It's a very straightforward way to reduce raw premium costs.
Okay, let's pivot to the absolute core focus of today's deep dive. We've established how to act after a crash and how to lower premiums. But what happens when the damage is catastrophic?
The total loss.
Right. The accident happens, the tow truck takes the car to the yard, and the mechanic just pronounces it dead. It's a total loss.
Yeah.
This introduces the ultimate financial pothole, and it's a vital concept everyone needs to fully understand before they ever finance a vehicle.
And we're talking about GAP insurance.
Yes, GAP insurance.
To really understand why GAP insurance exists, we have to examine a mechanism called the depreciation trap.
Okay, tell me about the trap.
When a car is totaled, people generally assume their comprehensive or collision coverage will just write them a check for whatever they originally paid for the car, or at least enough to pay off their car loan.
Right, to make them whole.
Exactly. But standard auto insurance does not care about your bank loan. Standard insurance only pays the actual cash value, or ACV, of the vehicle at the exact microsecond before the crash.
Quick pause. Got a question you want covered on an upcoming episode? Use the Send Us a Text link in the show notes and tell me what you're dealing with. I read them and I pulled topics straight from your messages.
Which brings us to the subjective, often incredibly frustrating process of how adjusters calculate that actual cash value. They aren't looking at your loan documents.
Not at all.
They are doing market research.
Correct. The adjuster looks at what similar cars, same make, model, year, and mileage are actively selling for in your specific zip code.
Right.
And because cars are depreciating assets, that actual cash value drops like a stone. A brand new car can lose up to 20% of its value in the first year alone.
20%, just like that.
Just like that. The second your tires roll off the dealership lot and hit public pavement, that vehicle transitions from new to used, and thousands of dollars in value instantly evaporate.
I always think of standard auto insurance as this highly restricted financial time machine.
How do you mean?
Well, it doesn't take you back to the dealership when the car was shiny and new. It only takes you back to 5 minutes before the crash when your car was already used, worn, and heavily depreciated.
That is a very accurate way to view it.
And GAP is the ticket for the rest of the trip.
Exactly right. GAP stands for Guaranteed Asset Protection. Its solitary purpose is to cover the financial void between the car's depreciated actual cash value and the remaining balance on your auto loan or lease.
So explain the math to me here. Because seeing the numbers really illustrates how devastating this can be. Let's say you finance a brand new vehicle.
Okay, let's walk through the scenario. You go to a dealership and you finance a new car for $30,000.
Okay.
You drive it for 6 months, suddenly you get into a severe accident and the car is totaled. Or alternatively, it gets stolen from your driveway and is never recovered. You filed the claim. The insurance adjuster runs their localized market comps and determines that the actual cash value of your now used car is only $25,000. So they cut you a check for $25,000.
But wait, I financed $30,000. Even with 6 months of payments, I still owe the bank way more than $25,000.
Precisely. Because early loan payments go heavily toward interest, your principal really hasn't dropped much.
Right.
Let's say your loan balance is still $28,000. The insurance company gives you $25,000. You are now in a position the industry calls being upside down or having negative equity.
So I'm short $3,000.
Yes. You are personally legally on the hook for that remaining $3,000 difference.
That is a brutal reality check. You literally have to write a $3,000 check to a bank for a car that is sitting in a scrapyard. It's a monthly payment for a ghost car.
It happens every single day. People are shocked by it. But if you had GAP insurance on your policy, that specific coverage kicks in and pays that $3,000 difference directly to the lender.
Oh, wow. So it just wipes the slate clean.
It wipes it clean. You walk away without a car, yes, but you also walk away without sudden, crippling debt.
Since GAP covers this highly specific financial crater, the crucial question for anyone listening is, how do you know if it fits your current budget? Who absolutely needs to be buying this coverage?
There are a few very clear profiles of drivers who should not skip GAP insurance. First and foremost, new car buyers.
Purely because of that steep 20% depreciation cliff we just discussed.
Exactly. Second, anyone who makes a very small down payment or, zero down.
Right, because you have no equity.
Right. If you don't put a substantial chunk of cash down up front, your loan balance instantly starts out much higher than the car's depreciated value.
What about loan length? I know 72-month and even 84-month car loans are becoming incredibly common as car prices just keep rising.
Long loan terms are the third major profile. If you take out a 60, 72, or 84-month loan, you're paying down the principal at a snail's pace.
Because it's mostly interest at the start.
Exactly. The car's physical depreciation will massively outpace your loan payments for years. You will be upside down for a very long time, making GAP essential.
Okay, any others?
Yes. Finally, if you are leasing a vehicle, GAP is basically non-negotiable. In fact, most lease agreements automatically build GAP into the contract because the dealership wants to protect themselves from that exact shortfall if the leased car is totaled.
Okay, I want to flip this scenario. We know who needs it. When is a consumer getting scammed? Like, when is buying GAP a complete waste of money?
You do not need GAP if you are buying an older, high-mileage used vehicle.
Because it's already depreciated.
Right. The massive depreciation hit has already occurred. The value has leveled off. You also don't need it if you make a massive down payment, say 20% or 30%, because you start the loan with positive equity.
Oh, I see. So if I owe $10,000 on a car that has an actual cash value of $15,000, I'm not upside down.
Exactly. A total loss would pay off the $10,000 loan and actually leave you with $5,000 in your pocket. In that scenario, GAP would provide zero benefit.
That makes total sense. Now, I really want to dig into the actual logistics of buying it because there is a psychological trap here that our sources highlight beautifully.
The finance office.
Yes, anyone who has ever bought a car knows the exhausting marathon of the dealership.
Yeah.
You negotiate for hours, you finally agree on a price, and then they send you to the finance office to sign the paperwork.
And that is exactly where they put you GAP insurance.
Exactly.
It is the ultimate test of decision fatigue. The finance manager will casually offer to roll GAP coverage directly into your auto loan. The catch is the cost.
How much is it?
Well, at a dealership, GAP is sold for a flat, one-time fee that typically ranges from $300 to $500, sometimes even more.
But the sources reveal a massive discrepancy here. You don't have to buy it from the dealer.
You absolutely do not. You can purchase GAP coverage directly from your own auto insurer as a simple add-on to your standard auto policy.
And the cost difference is just staggering.
It really is. From an insurer, GAP typically costs between $20 to $40 a year.
Wait, let me get this straight. A dealer charges $500 up front, but my insurer will charge me like $30 a year.
Yes.
If I hold the loan for 5 years, that's $150 total from my insurer versus $500 from the dealer. Why on earth do people accept the dealership offer?
Honestly, because of the environment. You're tired, you just want the keys to your new car, and the finance manager makes it sound invisible. They say things like, it just adds $5 to your monthly payment.
Oh, so it feels painless in the moment.
Exactly. But it is a pure convenience tax. Not only are you overpaying for the coverage itself, but because they rolled that $500 into your loan, you are now paying interest on that $500 for the next 5 years.
That is insane.
Yeah, purchasing it as a standalone endorsement from your insurer is almost always the smarter financial play.
And it requires active management, right? Like you don't just buy it and pay for it forever.
Active management is key. GAP is only useful while you have negative equity. As you faithfully make your car payments over 2 or 3 years, the gap between what you owe and the car's actual cash value shrinks.
All right, they get closer together.
Until eventually, those two lines cross. You owe less than the car is worth. The minute you reach positive equity, you must call your insurance company and cancel the GAP endorsement.
Otherwise, you're paying for nothing.
Exactly. So you stop paying for a safety net you legally cannot use.
Wow. It is entirely on the consumer to stay vigilant. Which really brings the mission of today's deep dive full circle.
We have mapped out a lot of the hidden hazards of the road today.
We really have. We've navigated the chaotic 10 minutes after a crash, realizing that silence and documentation are your best legal defenses.
Crucial.
We've explored the actuarial logic behind teen driving costs and how things like executive function and telematics apps can actually save you money.
Yes.
And we've thoroughly decoded GAP insurance, outlining exactly who needs it, who doesn't, and how to avoid that $500 dealership convenience trap.
The overarching lesson across all these sources is that driving isn't just physical. The financial risks are baked into the contracts you sign, the deductibles you select, and the coverage you manage over the lifespan of your vehicle.
So, to you listening.
Yeah.
The next time you or a family member are sitting in a dealership finance office, taking in that intoxicating new car scent, I want you to look past the shiny paint.
Run the numbers.
Run the numbers right there on the chair. Ask yourself what your loan-to-value ratio is and whether you are financially prepared for the brutal reality of sudden depreciation.
Because the market doesn't care how much you love the car. That depreciation begins the exact second your tires hit the street.
It's a harsh truth. But it leaves me with this final thought. We've talked so much about the rapid depreciation of vehicles and the rise of telematics apps that track our every braking habit and G-force turn.
Right.
With cars becoming these massive depreciating digital sensors, how long until the traditional auto policy vanishes entirely?
Oh, that's an interesting question.
How long until cars are priced, depreciated, and insured purely by the mile, making the very concepts of totaling or owning a vehicle completely obsolete?
It's a technological shift that the insurance industry is already preparing for.
Something to mull over the next time you're cruising down the highway, trusting the physics and hoping you never have to test the contracts. Thanks for joining us on this deep dive.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.